It's been 1 year since President Obama signed the Jumpstart Our Business Startups Act into law. The so-called Jobs Act was supposed to make it easier for small firms to raise money and create jobs. But since the law was enacted, unemployment has only marginally fallen. Initial public offerings are on track to decline, and it hasn't helped capital flow to small businesses. It was supposed to be the ticket to job growth.
Because of this bill, startups and small business will now have access to a big new pool of potential investors, namely the American people. For the first time, ordinary Americans will be able to go online and invest in entrepreneurs that they believe in.
But things are going slow. It could be a long time before we see results, good or bad, from the Jobs Act.
The SEC is in grave danger of loading down the process with such heavy regulation that entrepreneurs will look at it and say, wait a minute, it'll be too expensive and take too long to do this.
The Jobs Act, passed with bipartisan support, eases a variety of accounting and disclosure rules for companies with sales of less than $1 billion. That covers as much as 90% of companies that want to go public. It saves companies money they would have spent complying on regulations and allows them to put that towards investing in their businesses and hiring people. The Jobs Act also legalizes startups to raise up to $1 million in equity funding online, a process called crowdfunding, and removes a decades-old ban on advertising private securities offerings, or in legal speak, general solicitation. The law is well-intentioned. Over the past 17 years, 65% of jobs in America were created by small businesses. After the recession, unemployment remains stubbornly high. Small businesses have found it difficult to get loans to fund themselves and expand. According to a 2012 survey by the National Small Business Association, over the past 4 years, almost half of small businesses have had trouble getting needed capital. But the internet funding and advertising portions of the Jobs Act require rules for implementation. The Securities and Exchange Commission has yet to write those. Former SEC Chairman Mary Shapiro delayed rule issuance on concerns small investors could be duped into risky investments they don't understand. Regulators are also tied up implementing the Dodd-Frank financial reforms. So despite relaxed regulations in place, IPOs are on track to fall 21% to just 63 since last April. Compare that to 486 IPOs done in 1999. The IPO market has also been sluggish for other reasons: the soft economy, a volatile stock market, and recent high-profile IPO snafus such as Facebook. Mark Calabria, Director of Financial Regulation Studies at the Cato Institute, says relaxed regulation hasn't been enough to bring companies to market.
The Jobs Act did not go far enough. I think we, and so much of Sarbanes-Oxley was, again, misplaced at the wrong things. It's important to keep in mind, for instance, all of the corporate governance rules that were promulgated under Sarbanes-Oxley, companies like Enron were already compliant with. It was a wrong fix at the time, which simply added a lot of cost.
Sarbanes-Oxley, the law referenced by Calabria, was passed in 2002 to strengthen accounting rules in the wake of Enron and WorldCom scandals. It requires companies to have an independent audit of financial statements before going public. The Jobs Act does away with that. That means the Jobs Act may help more small businesses get money through IPOs, but it also means anyone investing in an IPO needs to know what they're investing in and that the company is able to go public without an outside audit confirming the company's credentials. That aside, there are other issues in play. Chris Camillo, author of Laughing at Wall Street, says it's hard for companies that have to plan years out to pivot immediately based on changes in legislation.
It's going to take years. Pipelines need to get filled again. Economic situations need to be right for companies, and really most companies are just now starting to really absorb the impact of the Jobs Act and put it into their plans.
What about all those jobs that were supposed to be created? They're on hold since the SEC hasn't written the rules yet for the crowdfunding allowance. Those are expected later this year. Once the rules are in place, Camillo, who is also directing a documentary on crowdfunding or raising money over the internet, thinks it could create an economic boom by unlocking new businesses and jobs. Crowdfunding expands the pool of investors startups can tap beyond the traditional circle of owners, relatives, and venture capitalists to neighbors, friends on Facebook, and strangers in other states who believe in an entrepreneur's idea. Instead of getting money from a few investors that take control of a company, there will be small investments from many. Anyone can be an angel investor. For every bank that didn't want to lend to mom-and-pop restaurants, bakeries, and small businesses, a loyal customer might be happy to invest and help that business grow.
It might not seem like a big deal, but when you talk about hundreds of thousands to millions of businesses in that situation that will be able to go out to their customer base, whether that's hundreds or thousands of people, and expand to a second location or even expand their equipment to be able to handle the existing business they have in their own geographic locale. That is a huge, huge impact in our economy that no one's really talking about.
Howard Leonhardt, an inventor and serial entrepreneur, might know best. He's founded over 28 companies in his 30-year investment career. The latest is the California Stock Exchange, which intends to help startups raise capital through crowdfunding.
I think that we're truly underestimating how much of an obstacle the old rules were for a normal person to get a business off the ground. And so I expect that we're going to have an unprecedented era of innovation and creativity. I'm an innovator, so I know how innovation works.
When Leonhardt set out to develop his first invention, a cardiovascular balloon catheter in the 1980s, he quickly learned how difficult it was to raise money for his idea. He needed $1 million to get his device cleared through the Food and Drug Administration and set up a manufacturing facility. But he could only solicit from accredited investors, people with $1 million in assets excluding their home and cars. Under the rules at the time, he couldn't advertise to the general public. He had to know wealthy people personally. Coming from a middle-class family, he didn't know a single person of that stature. He asked a lawyer if there was a workaround. There was an exemption to raise money from 35 non-accredited investors, or people who didn't have $1 million in assets, excluding their homes and cars. But going that route meant higher legal fees because greater documentation was required to guard against potential lawsuits from smaller investors.
In my case, I ended up having to wait 10 years to really get my invention off the ground. And finally, when I did, we grew from 35 employees to 500 employees in 24 months. But there was a 10-year delay to get it launched, which now, if crowdfunding would have been available back then, I would have been able to get it launched much earlier.
But Mark Calabria of the Cato Institute isn't sure crowdfunding will live up to all of the hype.
Proponents and opponents of this have exaggerated. This is not going to turn the economy around in any short run. I do think it's got the possibility to help us generate a few small firms that can potentially grow into big firms that can actually change the economy, but it's going to be a long, slow process.
That goes for the overall impact of the Jobs Act as well.
It really could easily be a decade before we know the full ramifications of this, whether it's going to be a positive or negative. So certainly the bottom line is it's simply too early to tell.
The risk of crowdfunding is that it could come at a cost. Fraud or losses for small investors who don't understand what they're investing in or who take on too much risk. If you decide to invest via crowdfunding, heed these tips. Don't put all of your eggs in one basket. You're better off investing $200 in 10 companies than $2,000 in one. Invest in a company that's been vetted by what's called an accelerator or incubator. These groups handpick entrepreneurs with promising businesses and mentor them. Many crowdfunding portals will be set up for national or even international investing. Focus on investing in your local area.
I think that one way to reduce your risk is go to local meetings. And here in Santa Monica, almost every week there's a forum for local entrepreneurs to meet local investors. I would suggest to go to those forums and to meet the CEO and CFO and talk to other people who are in the field.
Finally, get to know the CEO and Chief Financial Officer and bet on people you believe in. For the Wall Street Report, I'm Jennifer Schonberger in Washington. And that's our show. Thanks so much for tuning in. As always, watch us online at www.youtube.com/Wall Street Report. Email us at wallstreetreportwithjen@gmail.com and follow me on Twitter @JenniferIzzo.